Welcome to Yahoo Finance this Wednesday, March 19th. I'm Julie Hyman, Josh Schafer here with me, and we are moments away from the Fed's decision on interest rates. In terms of what we're seeing in markets ahead of that decision and a new dot plot, we are seeing stocks move slightly higher here after what has been a volatile month or so for the markets. Right now, we've got the Dow up 122 points, the S&P up about almost 0.5%, the Nasdaq up about 0.7%. And of course, we're also going to keep an eye on other assets like bond yields, which are moving very slightly higher today, hovering around 4.3% or so. Josh, not a lot of suspense about whether we're going to get a move on interest rates, but dot plot suspense to some extent, economic projections to some extent, and whether we're going to see any change to the Fed's balance sheet.
Yeah, overall, it seems like the consensus take coming into this would be that the Fed will move up its projection for inflation, move its projection for economic growth down. What does that mean for cuts? If cuts stay at 2, then maybe that doesn't move the markets too much, but there seems to be maybe a little bit of suspense of if that median dot plot were to move to 1 cut this year, perhaps how would the market react? But again, the real focus seems to be on the S&P, but then of course, really what Chair Powell says about those shift in projections once we actually get to 2/3.
Yeah, and it's interesting because for a meeting at which no cut is expected, there's actually a little bit of action to be had because of these things. Krishna Guha, who's vice chair over at Evercore ISI, wrote in a note, he said, this meeting's supposed to be a non-event with the Fed in wait-and-see mode, but it looks to us like a tricky meeting with more than usual risk to markets. So that's the setup here.
Well, and that's just where markets have been coming into this meeting, right? We had the S&P 500 enter correction last week, 10% drawdown. The market's been skittish on really any sort of news event. Yeah. And so I think everything just seems to mean a little bit more right now to markets.
Exactly. So the parsing of Jay Powell's commentary going to be in an even more heightened state than usual here as we have stocks moving higher. The Fed's decision out. Yahoo Finance's Jennifer Schonberger has the details.
No change. The Federal Reserve holding rates steady in the range of 4.25% to 4.5%, but retaining their outlook for just 2 interest rate cuts this year. The Fed announced they will begin slowing the runoff of their balance sheet beginning next month in April. They will allow treasuries to roll off at a rate of $5 billion per month, down from $25 billion, though they will allow mortgage-backed securities to continue rolling off at the pace of $35 billion per month. The Fed did increase their outlook for inflation and lower their outlook for growth. They now see inflation as measured by core PCE rising 2.8% this year. That's up from 2.5% previously. Meanwhile, they lowered their outlook for GDP to 1.7% this year. That is down from 2.1 forecast before. The unemployment rate seen edging up to 4.4 from 4.3 previously. While the median projection is for 2 rate cuts this year, a large chunk of the committee has become more hawkish. 4 officials saw cutting rates by just 1 rate cut this year, while 4 other members saw no rate cuts this year. So we're looking at 8 members of this committee that have become more hawkish. So kind of a close call there on just the 2 cuts this year. Now, policymakers said in their statement that uncertainty around the economic outlook has increased, though they retained their characterization of the economy, saying that economic activity has continued to expand at a solid pace. This decision was not unanimous. Fed Governor Chris Waller dissented, saying that he agreed with the notion of holding rates steady, but wanted to continue the balance sheet runoff at the current pace. Guys?
Jennifer, thank you so much. So indeed, what we were talking about here, not changing on rates, but indeed increasing the inflation forecast, as Jennifer just talked about, to 2.8%, decreasing the GDP forecast to 1.7% here. So definitely seeing perhaps an expected change here. I guess there's some back and forth about what exactly was expected on that front, but in terms of the exact numbers. And then that balance sheet runoff going to be slowing as well.
Yeah, I thought it was interesting. Jennifer pointed out you had 8 officials that actually favored either no cut or 1 cut this year. It's going to be interesting to hear as we listen to Fed Chair Powell how hawkish he might be given that, sort of where his stance is within that. But I think the GDP revision largely fell in line with what we've been hearing from Wall Street economists, right? We've been talking for the past month about everyone expecting the U.S. economy to perhaps grow a little bit slower than expected. 1.7 is around a number that a lot of these banks have sort of been talking about. So I don't think, as far as growth scare fears go there, that's really stoking any fears there. The other interesting thing is the unemployment rate forecast coming up to 4.4%. How worried is the Fed getting about the labor market and the overall health of the economy seemed to be a big theme coming into this press conference. And so where Chair Powell lies on that might be one of the market movers.
Well, and they used the magic word that everybody's using right now, which is uncertainty, and that uncertainty has increased. So that's really been the name of the game. Let's talk more about the latest decision by the Fed, the latest commentary. Michael Kushma, Morgan Stanley Chief Investment Officer of Broad Markets Fixed Income, is with us, along with Sonia Meskin, UBS Investment Bank Senior Economist. Thanks to you both for being here. It feels like sometimes the Fed, because we only hear from them once a month at most, that sometimes this kind of stuff is just them catching up to where the rest of the market and economic projections are. Michael, is that kind of what this meeting is that the kind of reset?
I think they're trying to make sure that the market is in line with their thinking, to project what they truly, correct any misinterpretations of what it is they're trying to accomplish. But this time it's particularly challenging because you have private sector market participants. Some are more concerned about growth, some are more concerned about inflation, and that it's not clear, which one you should be more concerned with at the moment. They seem to be concerned with both, but leaving them unchanged. We can't decide yet which is the worst fear, except if the fact that if all the decline in consumer confidence is due to too high inflation, then if too high inflation is the source of problems, then cutting rates is not the right thing to do, even if you're worried about growth in the short term.
Well, Sonia, I want to sort of pose that question that Michael just raised to you, right? Where should the Fed be more focused at this point? We have the inflation forecast moving up, of course, right? But the growth forecast coming down, unemployment rate forecast moving up. Where do you feel like the concern should be from an economic perspective?
The Fed is facing an incredibly uncertain environment, just like the markets are facing an incredibly uncertain environment. And as we've mentioned many times in the last month, this trade-off between growth and inflation is extremely uncomfortable for them. We'd expected them to be a little bit more focused on the upside risks to inflation at this meeting, but you could see that there was obviously division on the committee as to which downside risks to try to short circuit at this stage.
So what does this then imply about where rates can go, or does it effectively mean that the Fed is almost frozen, or that its hands are tied to some extent if this sort of trajectory continues?
I don't think they're frozen. They're frozen on purpose, that they are waiting for more information. They've been big time believers in data watching and waiting for data to change policies. And I think they need to see which side it tilts to. Is inflation turns to be the bigger worry, or is downside growth? They've been very concerned with growth and unemployment. Certainly last year when they cut rates 100 basis points, they were much more concerned with the unemployment rate going up, and they talked about 4.4% being a kind of ceiling on it. But things have changed this year. We've gotten a supply shock coming from tariffs, potentially, a supply shock certainly coming from the labor market in terms of reduced immigration and all those factors. So you can see a really uncomfortable situation with growth slowing and the unemployment rate not going up very much.
How big of a risk then is stagflation overall to the economic outlook at this point?
It's very difficult to say which way the tariffs will develop, right? Originally going into this year, markets largely expected some deregulation, at least alongside some of the tensions in trade, and it appears that the tensions in trade have really taken over. And whether there is reciprocal tariffs from other trading partners that stay in place for a prolonged period of time or get resolved, it doesn't appear that around April 2nd, there's considerable positioning at this point in the markets. And April 2nd is actually can turn out to be pretty, we can get more news potentially on this front, right? So it's difficult to say where the Fed should be concerned in this environment until they see some hard data. And especially for the Fed that's said many times that it's data dependent. And so far, what we've seen is deterioration in the sentiment indicators. But the Fed has also, some of the Fed speakers have come out and said, well, the sentiment surveys have not really been that well correlated with data, hard data more recently. So we don't even know how much attention we should be paying to that relative to our past experiences.
I want to pick up on one thing you said about regulation, that the market, I've heard a lot of commentary that the problem now is a sequencing problem. That you're getting the tariffs first, you're getting the deregulation and tax relief after. But what deregulation exactly is the market looking for? And then how long would that, even if they put that into effect now, how long would it take for that to have an upward effect on growth?
Well, we now see a lot more focus, obviously, on trade and tariffs rather than deregulation. But we've certainly mentioned deregulation potentially in the financial sector or in the energy sectors, for example, and how far this really could have gone, as you point out, because some of the changes could be, more impactful if there's, for instance, pent-up demand. Then when you loosen regulation, you kind of release that pent-up demand. But in the energy sector, this may be less applicable, for instance, than in some other sectors, right?
Michael, I'm curious, we've been talking a lot about the Fed probably being in wait-and-see mode for a little bit here. How do you factor that in as an investor right now? Is there a way that changes your strategy at all? Do you wait to hear a little bit more? How do you sort of land on that?
It doesn't change it a whole lot. So we've been feeling like 10-year bond yields stay around 4.3%. They're stuck in a range. They've come down well off the highs, but to get to go below 4, you really have to think the Fed's going to have to accelerate their rate cuts, even beyond the 2 rate cuts that are coming. I think the terminal rate for the market has for the Fed funds rate in the end down the road, multiple years in advance, is still above 3.5%. So if you think about a 3.5% 10 cash rate, 4.3% bond yields, that's a reasonably upward sloping yield curve, but it's not aggressively upward sloping. So to get below 4, to get closer to that 3.5 number, or somewhere in the 3s, you have to be more worried about the economy, more worried about why the economy is going to be bad enough for the Fed to cut rates more aggressively than they currently are.
And so if the Fed doesn't cut it all this year, or only ends up cutting once, is that a risk to markets in and of itself, or not?
Absolutely. For bonds, yes. For upward pressure, unless that causes equities to crack, and equities drop 10, 20, 25%, and that might cause a bit for bonds and prevent bond yields from rising, nearly as much. But you could easily see a redo of 2022 in maybe a smaller version of it, where it's just stagflation's bad for everything. There's nowhere to hide. So you may think bonds are better than equities. You may lose less money in bonds than stocks, but you're still probably on the back foot.
How about the slowing of the balance sheet runoff tool? That as opposed to actually cutting rates. Like, does that change anything?
I don't think so. I've not been a big fan of worrying too much about the size of the balance sheet on the economy. We had that big reverse repo facility, which was very large. That's been run down. So maybe if they felt that now that we're gone to that, to run that down to very low levels, I'm not even sure if it's 0 or not, but the impact on money markets will be more impactful now going forward with QT, and the fact that the economy is weakening, and maybe they want to help support the economy through slowing the balance sheet runoff is not crazy. It's a very low-cost way of doing it, but it doesn't really affect our thinking about term premium or the shape of the yield curve at the moment.
Gotcha.
Sonia, I'm curious, just looking forward to today's presser. What's one thing that you're particularly interested in hearing about from Powell, whether it be on the inflation front or the health of the economy? What are you really listening for out of this press conference?
Well, certainly both of those, right? And we would expect him to address both, as he has in the past. But the thinking, what's interesting to us is in the past, the Federal Reserve has reacted to University of Michigan expectation numbers, which have come up. But at the same time, the research that we've done indicates that they've been more correlated with past inflation than with future inflation. So given this decision, it's, we would have expected them to focus a little bit more on higher inflation projections, especially as in the past. This would have been consistent with maybe taking out one of the rate cut this year, which they didn't do. It would be interesting to hear how he addresses that.
And apparently, even though they didn't take out one of the rate cuts, there was more dispersion in the dots in terms of what they're expecting. Michael, what about you? What do you want to hear from Jay Powell? What would you ask him?
Well, first of all, I think the communication read kind of hawkishly, and all the changes and the attitude towards 1 versus 2 versus 3 rate cuts. I think he's going to try to walk it back the other way and be a little bit dovish, to say, not to imply that we're hawkish. So I think that given the consensus was tilting that way, he's going to try to push it the other way and think that actually we're not going to raise rates, we're not going to do that, and that we are ready to provide stimulus if things deteriorate. So yeah, we're not doing anything today, but if things do get worse and growth does deteriorate more forcefully because of tariffs or whatever reason, we will respond to that. Because I think that if they think the economy will go into recession, that will bring down the inflation rate regardless of what's happening temporarily on tariffs and things like that. But I wanted to say that he still have a balanced mandate. We are ready to deal with either outcomes. Either inflation goes up, we'll switch. If unemployment goes up too fast, we will cut rates.
Interesting. All right. Well, we'll see what he says. Sonia, Michael, thank you so much for being here. Really appreciate it. And I just want to do a quick check of the markets as well, because we are seeing not only stocks maintain their strength, but build upon them a little bit here, which is interesting to see. The NASDAQ now up about 1.1%. The Dow's gaining about 140 points. That's about a third of 1%. The S&P up about a half of 1%. So effectively where they were around noon, right? So not seeing much change. People obviously are waiting for this, the press conference to try to figure out which way the wind is blowing and which way they should trade. Stick around. We got much more of Yahoo Finance's special coverage of Fed Day coming right up, including those comments from Fed Chair Jay Powell at 2:30. Markets are steady after the Fed's latest decision to hold rates, but it's the commentary we're set to get from Fed Chair Jay Powell that can really move markets, according to our next guest. For more, let's welcome in Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. That said, Matt, we did get some news here in terms of the Fed cutting its GDP forecast, increasing its inflation forecast, sort of acknowledging the uncertainty. Not anything that shocking here, but sort of in line with what the market was expecting. It does seem like we're painting a picture of potential stagflation. Is that how you read the statement? And if that's the case, why aren't markets sort of reacting more negatively?
Yeah, Julie, it's certainly giving some stagflation vibes. It's actually hard to see stagflation because either one is usually right. If growth is going to slow, usually that brings down inflation. If inflation's coming up, usually that means better growth. Right now, the Fed is saying directionally, growth is slowing, inflation hotter. And frankly, Julie, I don't get the market reaction. It's a pretty positive market move after the summary of economic projections hit the tape. But this, to me, if they're weakening their growth prospects to under 2%, that's a pretty fragile economy. And a fragile economy, if it can stay steady, is one thing. But if there's any disruption in liquidity or any type of liquidity event, that can bring shockwaves to the economy. We are tilting a bit more defensive here as we go through into the second quarter.
And, you know, as we were talking about with our panel and reaction and quick reaction there, the Fed really is waiting, right? Waiting for confirmation, it looks like, of maybe which way that's going to tilt. Or do they need to be worried more about inflation? Do they need to be more worried about growth? So it's interesting that in your case, you're saying, I'm not going to wait. I'm just kind of taking a step back here because we don't know which way it's going to go.
And the way it's been priced in, Julie, right now, stocks have actually priced in a worse economic outlook than the bond market. The bond market hasn't rallied that much and actually hasn't sniffed out any weakness in the economy to any meaningful extent, with the 10-year Treasury yield around 4.3%. That leaves bonds actually with better value. And if you do see an economic slowdown, the Fed's going to have to cut more than 2 times this year. The fact that they're saying the economy is going to slow down, but they're still only saying they're only going to do 2 cuts, to us, that could leave them behind the curve and then have to cut more in the back half if they push it off. So it leaves more value in bonds here than stocks. But at the end of the day, what we're seeing is a balanced portfolio is one that can hold up in different regimes. We're starting to see diversification come back this year. But the dollar is actually going to be key at the Powell press conference. The biggest trade in the world hasn't been in the United States. It's been international. A lot of that has been about the dollar going down. It is a bit weaker today. We're going to have to see if it keeps going down after Powell talks.
Well, and to your point about stocks versus bonds, it's unusual for stocks to be sort of pricing in a more pessimistic scenario than bonds, right? So which do you think is correct?
Usually the bond market is considered the smarter of the two, but I almost think about like 2 personalities, Julie, where the stocks are always optimistic. The bond investors are typically more pessimistic. Stocks are stories, bonds are math, are kind of the way we look at it. But we think the bond market is actually more wrong on this one than the stock market, that it hasn't repriced. And really the bond market is looking for the Fed. Right now the bond market, it has flattened a bit. In terms of the curve, that usually spells out a bit of weaker growth as the 10-year yield has come down relative to the 2-year yield. But they're waiting on the Fed to get that short end down, and that would anchor the longer end. But the Fed's not giving them the green light yet. And so, again, this comes back to the Fed. And as hawkish as they are in the first half, that might mean they have to be more dovish and back end load cuts in the back half. You got to be patient, but you're getting paid nice income while you wait. We think that's a good thing.
And Matt, of course, a big part of this calculus has to do with tariffs and the effect that they are going to have on the U.S. economy here. Now, defenders of tariffs will say they don't cause inflation. They cause a one-time or a temporary increase in prices that is not sustained, that doesn't make its way through the economy in a sustained way. What do you think of that argument, and how are you thinking about how inflation is going to move this year?
So we don't have a lot of historical data on this, right? I mean, we either have the 2017-18 tariffs or we got to go back to 1930. So there's been a pretty big window there. But at the end of the day, in the last Trump administration where tariffs were implemented, inflation averaged 1.6%. It actually didn't create as much inflation as you might think, but it's like a Facebook status, Julie. It's complicated. So right now, I mean, you've got oil prices that have been moderating. Lower energy prices could be disinflationary. You got a housing market, which has been driving much of inflation. That's starting to moderate. That can bring down inflation. And then the tariffs are a wiggle room here and there, but it could be absorbed by the companies. It could be absorbed by the countries that are exporting stuff to us. You add it all up, it probably isn't as bad as you might think, but it's giving a negative growth impulse. Only in the United States. I don't know how it's only in the United States, but that's what the market's pricing in. We think that's a bit misguided. We're all in the same economic cycle. And at the end of the day, if the U.S. is slowing, it probably means global growth is going to slow as well.
Well, but by the same token, Matt, I mean, you look at what this is prompting in some other countries. Look at Germany as one example, right? You see then a country that is injecting some stimulus at a time when we are pulling it back. So the other thing I've been asking everybody about is what then comes in form of stimulus here in the U.S. In other words, is there going to be some kind of tax cut package here that is going to juice that growth or prevent it from slowing further?
It's hard because we keep tapping that same pedal and looking for gas and just issuing more debt. I mean, it's a global debt super cycle. And, the United States has kind of run its course. We've been running a debt to GDP or deficit to GDP of around 6 to 7%. In the old days, that was only saved for recessions. Now countries do fiscal stimulus out of recessions just any old time they feel like it. It makes economic cycles very unique. We've gone 17 years with 2 months of recessionary period. That has never happened before in history. And we do think recessions do happen. We do think that debt is going to matter. This is basically a period now where the interest expense for the country is now more than the defense spending. So we're paying nearly $1 trillion just on interest. That's not sustainable, and we're starting to hit that period where it matters a lot more. In Germany, I hear you. There's more fiscal. We're going to have to see because that raises interest rates. It raises the long end of the curve. They're going to have to pay for that. It hurts on the real estate market. It hurts on borrowing. And so the more debt can often mean if you've got enough return on capital, that's one thing. But if your cost of capital is higher than your return on capital, that can be an issue over the longer term.
Matt, good to see you. Really appreciate it. And I think you're going to stick around and be with us after the presser. So appreciate that.
Thank you.
Joining us now with more reaction to the Fed's decision to keep rates unchanged is Esther George, Federal Reserve Bank of Kansas City, former president and CEO. Esther, it's great to see you as always. I want to dive right into it and ask about your experience with the Fed's assessment of hard data versus soft data, because that really seems to be what has sparked market concerns here is the talk about tariffs and the effect it has had on things like consumer confidence. How is the Fed weighing that versus the hard data, which hasn't deteriorated as much?
Yeah, it's a great question because I think as we look at the statement, the Fed statement really lays that out for us today, which is a characterization of the economy that looks very similar to their previous statement, which means the hard data coming in confirms that assessment. When you look at the next paragraph, though, that introduces the idea about elevated uncertainty, I think that gets to some of the survey measures and some of the soft data that is beginning to flash perhaps some warning lights to give the Fed pause and to say we need to be watching some of these conditions as they unfold. So they're very important. at the end of the day in terms of trying to gauge your longer run forecast.
And so as they are trying to sort of tip the scales to being more concerned about inflation or more concerned about growth, what do you think is going to be sort of the most important determining factors when it comes to that? How are they going to decide? When do they need to decide as well?
So remember, the Fed has been worried for some time about inflation. They have focused on this as a reason for why their rate path has been recalibrated, if you will, and a reminder that their most direct objective is to bring that inflation back to target. And right now, they're telling you, as you look at the dot plot, as you look at their statement, that inflation is elevated, and they have to keep that in front of them. The degree to which the economy slows, of course, will matter too. But an economy growing at 1.7 while inflation is high might not really push their hand on their rate decision. Now, if the economy slows more quickly, if you begin to see employment begin to suffer, then that's a different matter. So I think it's a matter of degree on the growth side. And on the inflation side, again, a primary area of focus for them, as it must be.
So we were, of course, also looking at the summary of economic projections, the so-called dot plot, and they're seeing two Fed cuts, two interest rate cuts still priced in here, but a large dispersion within the dots of those forecasts, perhaps reflective of the difficulty of the task right now. In your experience at the Fed, how unusual is that sort of dispersion? And talk to us about the then consensus building exercise of getting on the same page.
Yeah, so to start with, remember the dot plot is, 19 individuals laying out what they see happening over the coming year and looking out again to the next 2 years. Right now, what happens in the coming year is really the key focus. And what this dispersion is telling you is the level of uncertainty is higher. This often happens during times of transition in the economy, one way or the other, that you will get views to begin to diverge around what that means in the next 12 months. And you see that, I think, in this current SEP. The process of bringing consensus around that, though, as you see in the vote today, is that they are able to coalesce around what does it mean for this meeting? Not a promise about what happens the next meeting and the rest of the year, but to say for today, they are satisfied that they will watch the data to see if it confirms the forecast that they've put out for 2025. And so I think that's the message from this. Consensus always there in terms of trying to decide when the right timing is. And I think for now, wait and see continues to be their mantra.
So 9 policymakers now saying there are going to be 2 cuts, but 8 now see 1 or no cuts. Esther, what's your best guess at what happens and how many cuts we get this year?
Well, I think putting 2 in that forecast is a reasonable number. Again, depending on how the economy unfolds, of course. If this weakness turns out to be temporary, if there is some clarity that comes about, if there is some adjustment to some of the things that are currently worrying both consumers and businesses, then you might see the path ahead allowing inflation to shift gears and continue its downward trend. But I think if inflation proves stubborn, as it has been the last few months, you will see them hold on longer. And remember, they have to carefully be watching inflation expectations. We've seen some survey measures begin to show those rising, and that is not what the Fed wants to see as they try to, again, calibrate the economy without, causing more damage than they need to.
Right. Esther, thank you so much for your time. Appreciate it.
Nice to be with you.
Thanks. We're just a few minutes away now from hearing from Fed Chair Jay Powell and his press conference. Well, he will be taking questions from the press. And in advance of that, we are seeing stocks hold up pretty well here, pretty much in line with where they have been throughout the day. The NASDAQ leading gains. It's up about 1% here. The S&P up about 2/3 of 1%, and the Dow up by nearly 0.5%. With Fed Chair Jerome Powell speaking following the latest decision by the FOMC to not change rates. But however, we did see a number of changes, including a decrease in the committee's GDP forecast to 1.7% for this year, an increase in its inflation forecast to 2.8%. A lot of talk about uncertainty, a lot of talk about weighing the sort of growth depression forces in the economy right now versus the inflationary forces in the economy right now, namely tariffs. A lot of discussion of tariffs, and the Fed chair sort of saying that for now, he used that word, that very loaded word, transitory, that got the Fed in a lot of trouble during the pandemic, but he seems fairly confident for now that it could be transitory, but the Fed wants to wait to see. Josh Schafer still with me here. So Josh, what stood out to you?
Yeah, I mean, that seemed to be the headline, right? That's when stocks started to move a little bit higher, and then we sort of just went higher from there throughout the press conference. I mean, Chair Powell saying that a, quote, good part of higher inflation expectations is, quote, coming from tariffs, but transitory impact is, quote, the base case. Essentially saying that a one-time price increase is not going to necessarily change the Fed's outlook. This matches what a lot of economists have sort of been saying about the tariff impact for inflation overall. And the other thing, Julie, that really stood out to me, we've been talking so much about this quote unquote soft data, survey data, right? And sort of what that could indicate, this weakening consumer survey data. And does that mean that consumers will stop spending? Does that mean businesses will stop spending? And what Chair Powell said is essentially the correlation between those two data points, between soft data, what consumers say they're going to do, and what they actually do, which would be hard data like consumer spending, hasn't been that tight. So at this point, until he starts seeing it in the hard data, the slowdown fears that you're getting from these surveys, he's just not quite believing it at the level that I think the stock market, going back the last couple of weeks, might have been pricing it.
Yeah, and he still emphasized patience and said we're at a place where we can cut or we can hold. He didn't offer the other option, which is that we can raise rates. Right. So maybe that's reassuring, not that anybody was thinking that that was going to happen. It's really interesting to see stocks rising in the face of all this. As you mentioned, stocks were up already, but then really taking a leg up on some of those comments, maybe a reassurance that this is not something necessarily that is going to stick around and have more of an effect on the economy. We've got all three major averages near the highs of the session right now. The S&P up about 1.4%, the Dow up 1.2%, the NASDAQ up about 1.8%. And when we look at bond yields, we have seen them come down as he was talking here. So the 10-year yield moving down towards around 4.26%. Not huge moves there in the bond market, but notable to see that little bit of a move down.
Definitely. And I think the overall stock market action, Julie, just fits with the fact that I think Chair Powell sort of matched what the narrative has been recently. So we had this big drawdown in stocks. Everyone started to get worried about growth. And then it felt like a lot of strategists and economists said, okay, we're more worried about growth than we were, but we're not talking about recession. Right? He was asked directly about recession, and he said, well, there's always odds of a recession. He put them at 1 in 4 on a standing basis. Some people put it at about 15%. But his point being, maybe we've moved a little bit closer to that range. But if the stock market had been pricing in anything close to recession over the last month, as we drew down 10%, a pretty aggressive drawdown, that's normally what you would see ahead of a recession, maybe we got a little bit over our skis from a market perspective on how big of a slowdown people see right now. But of course, he caveated that with, everything's uncertain right now. So maybe the big tariffs do come and things do get worse. And I think that was also the big prevailing takeaway from this is we just don't know right now. We do not have enough answers to plug all of this into a model and feel any sort of level of confidence of where things are.
And another caveat with the market reaction is it is not unusual to see a strong reaction on the day of this presser and then a complete reversal the day after. We'll see what happens this time. But let's get more perspective on those latest comments from Fed Chair Jay Powell. Let's welcome back in Matt Miskin, John Hancock, Investment Management, Co-Chief Investment Strategist. So, Matt, first of all, what do you make of this very positive equity reaction here? What gives?
So the bond market is pricing in another rate cut on this, and I don't really get the bond market reaction. I mean, I think, well, so if you look at equities and everything rallied right until the question about are you going to cut in May? And he was like, I don't see us being ready to cut in May. And the market actually started to taper some of the gains at that point. But the bond market going from 2 rate cuts to 3 rate cuts, and Julie, I'm talking on the margin here, we're talking percentage points changes, but the fact that Powell's pushing this first cut out, to me, is hawkish. That was the most hawkish statement of that whole presser. But if we're not cutting, until really the back half, I think that's going to be a bit more hawkish than the equity market. It might wake up with a bit of a hangover after such a good day today.
I mean, could the silver lining, the more positive read of that means the economy won't be turning down enough by then for them to need to cut?
It could be. The growth expectation, though, Julie, is that, they were like, hey, one handle on GDP growth is pretty weak, frankly. And I think more it's the tariffs and the inflation part. I really think that was what's driving them, the tariff conversation, raising up that inflation forecast. And Julie, to your point, the feedback he was getting in that press conference was brutal. Between, hey, is this transitory all over again, like you did in 20, after the pandemic? Or, if you raised up your inflation forecast, why are you not raising rates? Or at least, why are you cutting it all? And so that's this friction with the Fed right now. They've had these problems where they've let inflation go too much. And I think that's the bias now, is leaning a little bit more hawkish. I think the equity market, just wanted to see anything. It started rallying in the summary economic projection. So it really didn't change during the press conference. But they like the thought that it could be transitory. We'll just have to see.
Matt, where do you feel like the equity market stands as far as tariffs go at this point? Do you feel like we're expecting something big to happen on April 2nd, aka getting all of the tariffs, or are we still at the point now where the market's sort of discounting that President Trump is going to come back on some of these tariffs that he's threatened?
It's really challenging to look through because technology stocks are really the hardest hit here in year to date and really along all these tariff headlines. And technology is probably not going to be hit the hardest on this. I mean, they do have global supply chains, but you think about industrials, or you think about other companies that are much more front and center as it relates to these tariffs. It was really just a sell U.S. equities in general, and a valuation re-rating that's gone to the rest of the world. Now, was that really because of tariffs? It's hard to say. Is it just rhetoric? But in general, what we've seen is just the equity market is just churning here. It's just trying to find its footing. But we just have a valuation re-rating. Stocks got cheaper here. High quality stocks in particular with the best profit margins, best balance sheets, those were sold off first. Quality is the worst performing factor. It doesn't necessarily align with the tariff risk. It may just have needed to take a bit of a breather after a great year last year.
Matt, obviously, and Powell sort of said that I don't know anyone who's confident of their forecast, meaning their economic forecast. It's a really murky time. There has been this, bad vibes in the market, for lack of a better way to describe it. Do you think we're going to start to get some earnings resets here? Do you think once we start to hear companies reporting, they're going to be cutting their numbers?
So we've already seen a big slice in terms of the earnings estimates in 2025. So we were at 15%. The street in general saw S&P 500 earnings at 15. Now it's down to 11. And to your point, Julie, I do think you're going to keep that down, and it's going to be tough because already times, and then earnings estimates that they keep coming down.
Matt Miskin.
Still have the best. Yes.
Matt, I think you're cutting out on us. We're going to have to leave it there for today. All right, here with a closer look at the latest market action, let's get to Yahoo Finance's Jared Blickery.
Thank you, Josh. Well, let's dial up the Wi-Fi Interactive. We have a basic risk-on reaction here. I think it's just a little bit better than feared. And let's check out the Dow right now, which is up 1 percentage point. I'm actually going to show you a 4-day chart because we have this rally that began last Friday with a lot of thrust on Friday and Monday. Yesterday we fell back a bit, but you can see on the Dow we are right back up to Monday's highs. Let's check in with the S&P 500. You can see a similar story, not quite back up to those Monday highs, but above yesterday's close. And here's the NASDAQ up 1.6% and still holding on to gains of about 2.8% over these days. And we can also take a look at the VIX, which has come down. It's trading below 20 right now, and that's options prices just kind of pricing in a little bit less uncertainty here, although I heard the word uncertainty about 50 times over that entire presser. So there's definitely a lot of uncertainty to be dealt with here. But here's a 4-day look on the VIX. And it had actually, a few days before this, hit 30. So meaningfully, it has come down finally. And let's check out the bond market as well. We can take a look at the 10-year T-note yield, which began the day up a little bit. I'll show you the intraday. We rose, and then right on the report, we sank. And so that's a difference of about 6 net basis points. Not huge. Sometimes you do see some outsized reactions in the bond market. This is just telling me no big surprises here. Quantitative tightening, a little bit of technical easing there, although they wouldn't officially call it easing. And here's the US dollar index. US dollar index was up slightly at 2 p.m., then it took a little bit of a dip, and it's still holding on to some gains, just nominal gains there. We can also look into some other markets. Gold, guess what? Gold hit another record high today. It is $3,060.60. That is the intraday higher. That is the all-time high priced in US dollars. And we can also take a look at Bitcoin, which got a little bit of a bump on there. And I do say that with a straight face. It's a risk-on, risk-off asset, holding 85,000 right now. And let's also get a look at silver, which is down about 1.44%. Interesting to see that price action. Copper was also up earlier on the day, but let's get to a couple of heat maps before I leave you. Here is the sector action. 10 sectors out of 11 in the green here, led by energy, led by consumer discretionary, and also tech. What is not doing well? Staples, healthcare, and utilities. So defensive sectors lagging today, that's bullish, and you see some reclamation of territory by the mega caps. And I'll leave us on the NASDAQ 100 heat map here. We see Tesla up over 4%, Broadcom up about 3.5%, Alphabet up 2.5%. Broadly speaking, this is a risk-on day, and I lied there. Let me show you ARK Innovation Fund components as well. That's where the real green is. We're seeing a lot of outside performance in unprofitable tech as well. Back to you guys.
Thanks, Jared. Well, the Fed keeping rates unchanged at March's FOMC meeting. Let's get to Yahoo Finance's Jennifer Schonberger, who has all the details. Hi, Jen.
Hey, Julie. The buzzword of the press conference day was uncertainty. Chair Powell remarking just how uncertain this environment is and noting that when it comes to the outlook for rate cuts this year. Aside from that, lots of talk about inflation. Chair Powell now saying that progress on inflation may have been delayed for this year and that the Fed's outlook for inflation has increased in large part because of expectations around tariffs, though the Fed chair said it's going to be difficult to parse out just how much of the increase of inflation is coming from tariffs versus other sources. He did say it's too soon to say whether tariffs will result in just a one-time price increase, though the base case right now is that the effect from tariffs on inflation will be transitory. Take a listen.
I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment.
Fed Chair Powell reiterated that the Fed does not need to be in a hurry to lower rates and that policy is well positioned right now. The costs of waiting for clarity are still low. He did also get questioned about whether the odds for a recession have risen, and he actually ended up pointing to outside forecasts, noting that yes, odds have risen, but risen from a very low level last year and are still low. There's always still a 1 in 4 chance that you could have a recession, so sort of dodging that a bit. He also talked about inflation expectations, given that inflation expectations have ratcheted up higher in the short term, but he noted that long-term expectations still remain anchored based on surveys and based on looking at break-evens in the marketplace if you look at tips versus nominal treasuries, though he says the Fed is closely watching that. I also asked him about whether the Fed is willing to have a recession to break the back of inflation, given the lessons from the 1970s that many Fed officials have said that they need to heed at this point. And Fed Chair Powell basically said that luckily we're nowhere near a 1970s scenario right now. Lastly, just on that balance sheet, slowing the runoff there, he says that's not intended to send a signal of any sort. They just like the idea of taking a slower course on that balance sheet runoff. Guys?
Jen, thank you. The Fed holding interest rates steady for March and releasing also its latest summary of economic projections. For more, we're bringing in Yahoo Finance senior reporter Alexandra Canal on the dot plot. Hi, Allie.
Hi, Julie. Yes, a summary of economic projections. It's only released once every quarter, so always a lot of anticipation heading into these meetings, but especially this time around because we've seen a lot of fear over stagflation, markets selling off. But so far, I mean, we're pretty much on par for the projections that we saw back in December. So most FOMC members anticipate 2 interest rate cuts to come this year. That would bring the Fed funds rate down to 3.9% in 2026, an additional 2 cuts, bringing us down to 3.4%. But I want to zone in on 2025, and really I want to compare that to what we saw in December, because even though it's the same cut projection, FOMC members are leaning a little bit more hawkish. So you see that in December, just one official thought that we would remain steady, so no cuts to come. But this time around, we saw 4 officials anticipating no change. 4 officials also anticipate just 1 cut, whereas you saw over here in December, 3 officials. And then again, we have the majority of members both here anticipating those 2 cuts. So let's get to the reason why. A lot of this has to do with the uncertainty that we're seeing from the Trump administration, particularly when it comes to tariffs and the impact that could have on inflation. So to that point, we did see a slight acceleration when it comes to inflation expectations for this year, 2.8% compared to what we saw in December at 2.5%. But what's interesting is that if we look out over the long term, 2027, we see 2%. That's the Fed's inflation target. That's the same as what we saw in December. And to that point, Fed Chair Powell really said that the base case there is for the tariff impact to be transitory. And that was very encouraging to markets. I also want to get a check on growth expectations because, again, that stagflation narrative that's been really permeating throughout Wall Street. Now, GDP growth, big change to the downside there. Before in December, most officials saw 2.1%. Now we're at 1.7%. And we are going to be below trend, below that 2% level that we've been enjoying over the past few quarters over the long term before settling at 1.8%. But again, very similar to what we saw in December. And then finally, a quick check on the unemployment rate, slightly hotter, 4.4%. But again, over the long term, same as December, 4.3%. And that's essentially what Powell was saying, was that you have lower GDP growth, higher inflation. That essentially cancels itself out. And then with the unemployment rate, only a change of about 1/10. So he basically said the forecasts haven't changed that much. Now, of course, the word uncertainty, as Jared was alluding to earlier, that was mentioned quite a few times in the press release. So perhaps we just need to see more data over the coming months, more clarity when it comes to Trump's policies for how this will all be impacted. But for now, it seems like things have not changed from the Fed perspective too much. And that's, of course, helping lift stocks. But again, we'll have to wait and see. Julie, Josh.
Allie, thank you. Well, that concludes our Fed Day coverage. Market domination begins on the other side. Hello and welcome to Market Domination. I'm Julie Hyman. Josh Schafer in for Josh Lipton today, live from our New York City headquarters. We've got about 20 minutes to go into the market close, and we're taking a look at the major averages here. And we are still seeing gains for all 3 major averages, come down a little bit off the highs of the session. But of course, this following on what we heard from the Federal Reserve and Jay Powell, and seeming really to emphasize the patience here in the market and waiting for more data to show if indeed some of the surveys that are showing lack of confidence are going to translate into more hard data that's going to be negative.
Yeah, Julian, stocks really sort of took off as Chair Powell started to speak, right? And they've come down a little bit, but generally speaking, we've seen that rally continue. We've seen bond yields move lower. It seems like the market position right now is the Fed is in a good place to help out if any of these economic concerns do come to fruition, right? It seems like the market may be perhaps favoring what Chair Powell was saying about being in a good position to shift and maybe cut rates sooner if that becomes an issue, which was interesting because largely his messaging was, we're probably not going in May, and I can't really tell you when we're going to cut rates again. He didn't seem too confident on exactly when that's happening, but at least what the stock market is telling us right now is they feel like if that economic situation does get worse, that the Fed will step in and cut rates.
It feels that way. All right, for more on the latest market moves, let's welcome in Dennis Debusschere, 22V Research President. Dennis, it's good to see you. What was your reading of the message from Jay Powell at that press conference? And did you find his message as reassuring as the market has seemed to?
Well, yes, in the sense that it was a major clearing event. You can't say that it was dovish on its own, but what we knew going in is that everybody was worried about the stagflationary kind of shift in the dot plot or the Fed's forecast. And the real question was, what was he going to do about it? And the risk going into the meeting was that he would focus on short-term inflation, the increase in short-term inflation expectations in particular, and potentially use that as a reason to be a little bit more hawkish, which, given their downtick in the longer-term growth forecast, would lead to even more downside. Theoretically, if you have to respond to increases in short-term inflation, they're a little bit more hawkish, and that creates risks to the growth outlook longer term. So you're not getting an acceleration related to the obviously tariff shock that is implementing impacting the long-term growth forecast. So in that sense, it's a clearing event. They talked about inflation being transitory. They're not going to respond to it. They have inflation up this year, but crashing that's too strong, coming back down next year on a core basis. So that was very much a relief to investors, which I totally understand.
What do you mean by a clearing event, Dennis?
Well, in the sense that, like I said, you didn't get a Fed that was going to accelerate the downside in markets, right? If the Fed is going to sit there and say, all right, if short-term inflation expectations are going up, inflation in the near term is going to be up because of inflation, and we're going to really push back against that near term and not still forecast a cut of 50 basis points over this year, then you have material risk of tighter financial conditions and a market that would be under pressure, in addition to the pressure you're already seeing from tariffs and the uncertain impact of the economy longer term. So just not having that or having that out of the way is an important positive.
But Dennis, you mentioned within those dots, I mean, we have slower economic growth, inflation basically staying where it is. I think most people would define that as relatively stagflationary, right? That's a stagflationary environment.
Yeah.
So what does that mean for an investor? Is that in and of itself still a concern in terms of growth in the environment that we're looking at over the next year?
100% still a concern. And it does mean lower earnings growth over time. The only thing we learned today is the Fed wouldn't add to that concern, right? So that's the clearing event.
On the flip side, are you concerned at all that the Fed is being too complacent here? I mean, I thought it was interesting, Mohammed El-Arian posting during the meeting of Queen's College, Cambridge, and Allianz, and he talked about the word transitory coming up again in terms of the Fed's view of the tariff impact on inflation. And he said, I would have thought that particularly after the big policy mistake of earlier this decade, and given all the current uncertainties, some Fed officials would show greater humility, he said. He said it's too early to call it transitory. What do you think?
Well, I agree that the word transitory is probably not ideal, given they used it last time. So that's very fair. That being said, he could not have said any more that they weren't sure what was going to happen, right? That we really don't know the impacts. So I think he showed a ton of humility in the fact that they just kept on saying they don't know. And if they don't really know, and none of us do, we haven't gone through tariffs in the modern economy, so we don't really know what the impact is going to be. And since that is the case, saying that you're basically on hold and that you'll view the inflation as transitory or temporary because it's directly related to tariffs short term seems like a fair way to think about it. So I disagree with that comment that they didn't show humility, but the word wasn't ideal. That's fair.
Dennis, I'm curious, Chair Powell said something that stuck out to me in terms of tariffs. He was talking about tariffs last time around on washer machines, actually ended up raising prices for dryers, and there wasn't actually tariffs on dryers, sort of that knock-on effect of tariffs and how it's hard to predict. Is that what the market's been struggling with over the last month, sort of the fact that this is just pretty challenging to price and there's not really a way to kind of get it right at this point?
Yes, it's absolutely what the market's been struggling with. And so now that we're through the Fed, we go back to that. What are the tariffs going to be? What will reciprocal tariffs look like if that's the plan, which appears to be the case? And then how will that impact the economy longer term? So on the one hand, today was positive because the Fed signaled they're not going to accelerate the downside of the economy by reacting to inflation in the moment related to tariffs. But we're still not past the uncertainty point of, it goes back to what I said. None of us have any idea. We haven't had tariffs in a modern economy like this, so we can't really forecast what the real impact will be. I mean, the fan chart on potential outcomes is still like, really wide right now. So right now, the tariff outlook looks a little bit less bad than it was. If reciprocal is the path, that's kind of a positive, but we just don't know.
And so what do you know about what to do with your strategy then, Dennis, right? How do you look through the tariff situation and try and figure out who's going to be resistant? Do you put it to the side? Like, how do you incorporate it and what do you do? Mm-hmm.
When I'm not hiding under my desk, I guess the way we would approach it is from a fair value point of view, and if you think about the market on a discounted cash flow analysis, even if you have 0% earnings growth this year, and you recover some of that next year related to tariffs and slowing economic growth, et cetera, there's not a huge amount of downside in the market, believe it or not, assuming equity risk premiums stay around this level, which I think is, pretty fair. So I think the risk reward in the market is actually decent. I wouldn't say great right now. If you factor in a decent amount of earnings risk, which is what a lot of people are doing. So that's the way we think about it, which related, and I should have mentioned this up front, that assumes that the administration wants to avoid a recession. That assumes that we don't really try and produce T-shirts and sneakers in the U.S. over time, that it's more of a reciprocal fair trade as opposed to a total reorientation of the U.S. economy that would lead us down the road potentially of a recession. So I think as long as it's an avoidance of a recession, yes, some near-term economic pain, but avoidance of recession, then the risk reward is okay. And if we're wrong on that, then, well, we're just wrong.
A challenging environment, Dennis, no doubt about that.
Yes.
Appreciate you joining us today.
Good to be here.
Stick around, much more market domination still to come. The Fed holding interest rates steady earlier today at March's FOMC meeting with the current Fed policy and a key changing of the guard for the Fed's top bank cop. We're navigating how to play the banking sector with the Yahoo Finance playbook. Joining us now is Saul Martinez, head of U.S. Financials Research at HSBC. Saul, I want to just start with the Fed today. It seems like we're still expecting potentially some interest rate cuts at some point this year. Market's still pricing about somewhere in that range of 2 to 3. Of course, that's where the median dot is. I guess just how are you assessing the Fed's the path of interest rates on the financial sector? If we do eventually get 2 cuts or if there's a risk of no cuts, how does that sort of impact financials?
Yeah, I know, and thank you for having me. A higher for longer, if the forward curve plays out and the medium to long end of the curve remains roughly where it's at, that's a pretty benign backdrop for banks and bank stocks. Because if you take a step back, the optimism around bank stocks that really emerged late last year and early this year really revolved around the view that we would have higher for longer environment, positive real rates across the curve, a soft, a moderate growth environment, some capital markets recovery. And that leads to a very simple financial algorithm that implies some net interest income growth, positive operating leverage, and then you have deregulation and more buybacks being allowed, and you get strong earnings growth. So to your question about the rate backdrop, 2 to 3 cuts is, you still have, an environment where the short end of the curve is still, at fairly elevated levels. And if the medium to long end of the curve remains where it's at, that's a pretty benign backdrop as long as the economy holds in there. So it's positive. I think what's happened over the last, handful of weeks is that financial algorithm or the underpinnings of that financial algorithm started to be questioned because of the uncertainty around tariffs and the uncertainty about the economy. But if the base case plays out, that's a pretty benign backdrop and for banks and bank earnings growth.
We had today, for example, Brian Moynihan, the Bank of America CEO, saying in an interview on another network that he seemed to not be terribly concerned about the consumer, which I think is interesting because everything else aside, stocks have gone down a lot. So you would wonder about the wealth effect as a result of that. How are you thinking about that? Do you sort of, not do you take him at his word, but do you think that it's going to stay that way, I guess?
Yeah, it's an interesting environment we're living in, right? Because forward look, some of the indicators, the sentiment indicators, have worsened. Obviously, as you mentioned, asset prices and equity prices have gone down quite a bit. So it feels worse than what the activity data is showing right now. And when you talk to companies and when you talk to banks, what you'll hear are things like, well, yes, our commercial clients are worried about tariffs. There's some concern, but we're not seeing it in the data. We're not seeing it in behavior. We're not seeing it in in activity data. I mean, we had data, for example, for through February for credit cards and credit indicators, and credit quality is good. I mean, you've seen some slowdown in loan growth, but the overall economic and credit indicators, loan growth, for example, they're kind of holding in there. Now, I wouldn't say you take Brian at his words, but I think you have to be watchful of the situation, and it does create the fact that we have more policy uncertainty, that we have greater maybe a higher probability of slower economic growth or even a recession than we had a few weeks ago. Yes, it makes sense that asset prices would go down, and you have to be watchful of that filtering into the real economy and into numbers. But at this point, you're not at a point where you're actually seeing it yet. So it is a sort of a challenging situation for an analyst. But you kind of have to look at this. This is our base case. It's still a good base case. But when you run scenarios and you probability weight different scenarios, you may want to put a higher probability on a downside case scenario playing out and be watchful and adjust your views and your forecasting, your target prices accordingly as the data comes in.
So outside of big tech, I mean, financials and a lot of the names in your coverage space have really been at the forefront of the selling action over the past month. I'm thinking of stocks like JP Morgan, Goldman Sachs, Morgan Stanley, all down about 14, 15% over the past month. Of course, those stocks, if I flip to a 1 year on our board here, have been pretty hot over the last year, right? And I'm curious, do you think they were a little bit of the momentum unwind from the market, or is there something materially changing to the fundamental story that makes you not a buyer here?
Yeah, I think I think there is some amount of the stock price reaction being an unwinding of positions that were, an unwinding of the outperformance and perhaps some investors, becoming overweight the sector. And I think, to the question about whether this is fundamentally justified, somewhat, because there are certain things that you are already seeing. For example, with a Goldman Sachs or a Morgan Stanley, there was a lot of optimism, and in our view, a lot priced in terms of a capital markets and investment banking recovery. And the beginning part of the year has been slow, and I think there is a greater likelihood that the investment banking recovery story is not going to play out to the same degree that we hoped for. I think you will see recovery. I think you will see growth, but maybe not what has been expected in the marketplace. So I think there is a fundamental underpinning. I think for the JP Morgans and Bank of Americas and Citigroups, I think some of the downdraft in the stock prices is justified in the sense that, again, like the underpinnings of why we are positive, there maybe are more risks to that view. So like when you look at different scenarios that can play out, is there a higher probability of a weaker economy filtering into the financial outlook? Yes, I think there is. That said, I personally do like the banks here because I think that the likelihood that we still see higher for longer positive real rates, some economic growth, I still think that is a high probability in the base case, and that's a benign scenario for these banks. So I do think there's a logic, I guess, to the sell-off, but I do think there's value here.
Saul, thanks a lot. Appreciate your time.
Of course.
Thanks. Well, wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.